It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and I'll tell you what, we have had quite the year. I think anyone would agree with that. It's been, wow, it's just been up and down and everywhere, and of course we've got all kinds of stuff going on and coming up still, and gosh, we got an election coming up still, so COVID's still not completely off the scenes, although there seems to be a lot of good news in that regard, which is awesome. There's been some good economic news, recovery stuff recently. I think much faster than most people would have predicted or thought. Of course, March we had a much faster kind of a drop, 30% drop roughly in the markets, like in a month, which took a lot of people by surprise. Tremendous recovery back, which also I think took most people by surprise. Jobs numbers and stuff coming back better than expected, again by surprise. Gosh, who knows what else we're going to get surprised by this year. And I guess that's the point I want to try to make here is I'm not a doom and gloomer. Please understand that. I'm actually pretty positive, upbeat about things, long-term economic futures and things like that of our country. I'm, very positive and bullish on in general. Of course, there's times and there's periods of times that that's different. But I guess, I don't know the way to describe it's going to be hard. It's going to be interesting. It's going to be interesting to see what, when 2020 is over, when we look back on it, we think about times in our lives that, made an impression. And I know for a lot of people, 9/11 is one of those times, and many of us remember. And, that was a shock to the system. And look at all the things that happened as a result just because of that one event. And when you take 2020, probably the biggest takeaway we'll take from it, of course, is the COVID. And look at all the changes our lives have just made just in the last few months. The shutdowns, I don't think that, the New Year's, if we were to go back to New Year's Eve, if any of you, watching the ball drop or at a party or wherever it was you were, think about that a minute. Think about where you were New Year's Eve 2020. And be honest with yourself. Could you have imagined what has happened? And this is what, August? Already. We've had a pandemic. We've had shutdowns. We've had riots in the streets. Like I said, we have an election coming up. There's so many things that have happened this year that, gosh, I don't think I think if you had predicted those things at that party or that event, New Year's Eve 2020, I think you probably would have been laughed at. People would have said, "Oh, you got to be kidding me." It's just, I don't think we could have predicted a lot of these things. And again, I'm not saying this as a negative. It's just, we're on a roller coaster, it seems like. That's maybe the best way to. It's been an amazing roller coaster of a year. And there's still a lot of uncertainty and unknown things coming forward. Overall, could they be good? Could some things be great? Absolutely. Could it turn into something really bad? Absolutely. I think again, I've shared this before, it's not that I'm being negative or doom or gloomer. What I'm saying is I just don't think anybody really knows. And Warren Buffett probably is one of the people I've listened to who I think maybe has said it best at his recent stockholder meeting. He said, look, I don't think anybody knows what's going to happen with the markets next week, month, or year. And gosh, if that guy doesn't know, I don't know how anybody else could. We see a lot of predictions. So I'm reading a lot of articles, and some of them, make some sense. Others I kind of look at kind of funny. And occasionally, I don't agree, but who knows? I guess this is a year where you almost can't take anything off the table because it's gotten more of like, well, I may not agree with that, but it could happen because look what's already happened. So, and occasionally you get one that's kind of brings a smile to your face. And I thought this was a funny article. This is a Market Watch article, and we'll post it on our website at yourpersonalbank.com if you want to check it out. But the title of the article made me smile, kind of got a chuckle, but it made a point. And the title is, "The Stock Market Looks Like Hapless Wile E. Coyote Running Off the Edge of a Cliff." says a behavioral economist. And I think, I kind of have to admit, that's a humorous way to put it. Can anybody really explain or connect the stock market currently to the current economy? And I think most anyone would agree, there's a major dichotomy. There seems to be no connection whatsoever. And like he said in this article, he says, never before have I seen a market so highly valued in the face of overwhelming uncertainty. I don't know if I could have said it better. We don't know what's going to happen. We're at or near all-time highs, all-time valuations. Article after article talks about this. Like I said, it even goes on further. It says the U.S. stock market is drunk from Dr. Pangloss's Kool-Aid. Hoping for the best of all possible worlds. Gosh, I hope that's exactly what happens for everybody's sake. We just don't know. And, talking about bullishness to the extreme and U.S. market hits record 77% overvalued. It's a Forbes article. Some of the highest overvalued places we've ever seen. Okay. And then even Warren Buffett talks about, he's talking about the Buffett indicator, which I thought was interesting. He says his indicator is basically, it's a measure of the total market cap of all stocks relative to the country's GDP. And like he says, when it's in the 70 to 80% range, it's time to throw cash at the market. When it moves above 100%, it's time to get out, as he puts it. He's lean towards risk off is their technical term they use. So, we're definitely in those places. What's going to happen? Like I said earlier, gosh, I don't really think anybody knows. I think the key point I'm trying to make here is this. Because of the uncertainty, and again, we have an upcoming election. I guess that's the only thing I want to point out here is, in my lifetime, we always hear every election that, this time, this makes the difference, this is going to be huge, make sure you vote and all those kinds of things. And let's be honest, in most cases, it's just one side or the other or both trying to, drum up the voters, get their voters to turn out, which, it's understandable. Okay. There's I would say maybe a couple of times in my lifetime that I can remember that an election really did make a difference. In other words, basically I'm an independent. I'm not, there's some things about both parties I'm not particularly happy with. Okay. And in many cases, I find, this is me personally, that I don't find a lot of difference between the two. I mean, there's some differences, key differences, but I don't see dramatic differences in many cases between the two candidates or the two parties. Occasionally, you do see major differences, and I think this is definitely one of those. In my lifetime, I'd say the last time I saw this kind of major difference was probably when Reagan first came along. Certainly, changes that occurred from that. I mean, the top tax bracket before Reagan was 70%, and it dropped to 28% in a matter of a few years. When you drop the top tax bracket from 70% to 28%, that has major ramifications on the economy and money and all those kinds of things. So that was a major difference, from that high interest rate environment, from the Carter years to what went into the Reagan years. It was definitely different. Whether you agreed or disagree, I don't think that's the point. It was different. I think we have that coming up in the future. Depending on which party is in place, in power, I do believe there's going to be some significant differences in terms of policy, money, interest rates, the economy, regulations, all those kinds of things. And that will have a major impact on investments and all that. The problem is we don't know who's going to be there. I think who knows? We don't know, and that creates additional uncertainty. I'm going to talk about some solutions to that uncertainty in the next segment. So stay tuned, because this is going to be important.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're talking about 2020 and quite the roller coaster we've been on. Like I said in the first segment, It's going to be interesting looking back on this year and what we think about it, but I think it's going to be pretty obvious that a lot of uncertainty, a lot of things have happened, and really, at this point, I almost won't take anything off the table as a possibility because there's been so many things that have happened already that it's, that most, surprised us in so many ways, or so many of us, that taking anything off the table this time just doesn't seem practical. And I guess what the analogy I'm kind of using is this, folks who are, predominantly still at risk in the market. I just want to say an analogy I think that might make some sense is it's kind of like we're on the Titanic. Now, we know there's icebergs out there. We don't know if we're actually going to hit one or sink, or if we're going to sail on through and be just fine. And that's and arguing about the deck chairs and rearranging, this sector or that sector or whatever, and those kinds of things that a lot of people do is, nothing more than rearranging the deck chairs on the Titanic. Like I said, it may just sail on through and be fine, and things will be great, and I hope that's the case. I really do. Or may just hit an iceberg and go down when it comes to your money. We just don't know, and that's the point, is we just don't know. There's so many uncertainties out there. And like I said, with an upcoming election that, depending on which party ends up in power, or if it's divided, that's going to make a big difference this time. Either side of the aisle you're on, I don't think there's any argument that anybody's going to have in terms of if one party's in power versus the other, that things wouldn't be quite a bit different, and in so many ways, and of course in affecting our money in so many ways, in the economy and all those kinds of things. And of course, we can't forget COVID's still on the radar screen. It's not gone. So there's that too. So I like this article. Like I said, it gave me a chuckle. Market Watch article says stock market looks like hapless Wile E. Coyote running off the edge of a cliff. And never before have I seen a market so highly valued in the face of overwhelming uncertainty. That's the title of this article, and I don't think I could have said it better. When you dive into it a little further, too, by the way, there's a Jim Cramer, I think he put it, he also said, and I like what he said here. He said, S&P 500 is like a patch of grass. It looks great from afar, but when you get closer, it's covered in weeds. His point in this is real simple. A lot of the big tech stocks like Apple and Tesla and stuff have had huge gains in 2020. And really what that's done is mask the general weak performance of most of the market. In other words, there's been a few really, really bright spots that have done really, really well. And if you're invested in those things, of course, you've seen tremendous returns this year. It's been, frankly, some of the best ever seen. But if you were outside of those particular tech stocks, basically, the actual returns have been closer to nothing and some losses. So it's not been all that great. My point is this: the uncertainty, and something again that's out there, is key. And then, like I said, and why I brought this up is some people say, well, the market's dropped. Yes, they did, but then they came back really strong. Not really. Certain big tech stocks did, but the overall market really hasn't, like Jim Cramer's pointed out. So my point is there's a lot more underlying than a lot of people are paying attention to. Why is this so important? Well, it's something called diversification. And most people who invest in the market and portfolios and such understand diversification to mitigate risk. You spread things around. You hope that hopefully if one goes up and the other goes down, they average each other out, so to speak, and things kind of work out. And there's certainly some of that. Like I said, if you were in some of the big tech stuff so far this year, that part of the portfolio has done really, really well. A lot of the other parts have not. When I talk about diversification, though, I like discussing diversification in terms of non-correlated assets. What do I mean by that? A non-correlated asset is something out there that has nothing to do in terms of price or value to the other asset. So let me use an example. If you're, market type investment, asset, whatever, some people say, well, there's different sectors and that mitigates, that spreads, that's diversification and stuff if you're in different sectors. I agree to a point. But when you have we can look back in March, for example, where we had a tremendous drop, roughly 30% drop overall in the market, and very, very few stocks weren't affected dramatically. In fact, if you go back to some of the previously recorded shows, yourpersonalbank.com, you can go back and I talk about in some of them where It showed that like in March, there was like one stock in the Dow that didn't lose. 1 out of 30. Or actually, I think it was the only stock in the entire S&P 500, if I remember correctly. My point is, overwhelmingly, 95% plus of the stocks lost, and many of them lost tremendously. So in other words, it's not really diversification when you have these big events, these big movements like we did in March because of COVID and stuff. Okay, diversification among sectors can work in a normal market environment, but when you have these big things like we had with COVID, like we saw in 08, 09, that's more like a tide where it raises all ships, a tide lowers all ships, or pretty much all of them. So that's when diversification into a non-correlated asset becomes paramount. And again, based on what I've seen in 2020, I wouldn't put anything off the table going forward in terms of what's going to happen. Again, I don't know if it's going to be great. I don't know if it's going to be horrible. I don't think anybody does. It could be either. It could be both. We've seen both already this year already. So who knows? My point is having some assets in that non-correlated asset makes sense. Stuff with some guarantees, consistency. Modern portfolio theory talks about all the time. 60-40 portfolio split. What are they talking about? The recommendation for that is 60% stock and 40% bonds typically, or asset or interest or dividend paying assets for more consistency, more balancing. What I'm saying is take it another level. Take it to a non-correlated asset, something that's not related to the markets, something that has guarantees. How about something that has some tax benefits? What about liquidity and access and use of the dollars? See, what I'm describing is your personal bank. See, if you take the name off of it or what the tool is, but I described this, what it does, just about everybody wants what it does. Very few people realize, in terms of when I talk to them, whether it's workshops on the Money Radio or whatever, realize that the name of the financial tool that does all those things is a personal bank. Now, a personal bank is two things. It's financial tools from two different industries, the insurance and the banking industry, combine, integrating those two assets, those two tools, to create the personal bank results. What is that? Take a high cash value policy, earning high cash, 6% dividends today. History of doing that over the last 25 years. I'll show you the charts. History of never missing dividends for over 100 years. A+ rated, huge cash value reserves, plans to continue. They're paying 6% plus today and plan to continue for the foreseeable future and have for the last 25 years. These are high, solid dividend payers. And then you combine that with the bank line of credit where you can access the funds at 3 to 3.95, depending on how much funds we're talking about. What does that do? Well, if you leave it there, it's growing. You're getting credit at 6, right? It's pretty simple. If you access it through the bank line, you're still picking up 2 or 3% positive arbitrage because the money's, where did you take the money from? Did you take it from the policy that's getting credit at 6? No. You took it from the bank line. The cash in the policy is the collateral for the line. The funds are still in the policy. They're still growing. They're still getting credited 6%. Your money's still growing at that 6%, right? And if you access it, and the cost to access is 3 to 3.95, what's your money doing? It's still growing. You're still picking up 2 or 3% on money you spent or allocated elsewhere. That's the key. That's the game changer. Stay tuned in the next segment because we're going to talk about this further on how this can enhance your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And like I said, we've been talking about, 2020 and uncertainty. Like I said, I'm not here saying that it's going to be good or great. I'm not here saying it's going to be bad or horrible. What I'm saying is we just don't know what's going to happen. And, my gosh, think about it. Look what's already happened. Who would have thunk we would have been in a situation? I remember a while back, it wasn't that long ago, you couldn't find toilet paper in a store. I mean, who would have thought that that would have ever happened? Who would think that we'd be having the riots that we have in the streets, or that, wearing a mask now is more normal than not normal? I mean, all those kinds of things. I mean, you have to wear a mask to go to certain stores these days. I'm not saying these things are good or bad or right or wrong. What I'm saying is, who would have thought we'd be dealing with this? And if you look at your money and the economy and things like that, we went from historic low unemployment beginning of the year. We had markets going great, crazy, growing like crazy, I should say. We had the economy going great. I mean, the economic situation looked rosy, and almost came to it. It was like slammed the brakes, and we had a horrible, March, 30% drops in the markets, in most cases, shutdowns, all kinds of things, and a tremendous run back up. Again, all these things that almost nobody expected, and we have been surprised by. And we have a big election coming up where I think most people would agree, irregardless of which side of the aisle you might be on. I think both sides are going to agree. Whoever's in charge after this, whoever's in power, whichever party, will make a big difference, a dramatic difference. That's not always true with many of our elections. The differences are more, I think, in my opinion, more minor than this time. This is one of those probably majors. Here's the thing. The thing is, we don't know. Who's going to be in power next year? Don't know. Is COVID over? I mean, are the effects of COVID pretty much over, or is we still got some residual stuff coming back, are we going to deal with? We don't know. We've had tremendous response. We had a market that crashed in March and recovered fully back up a few months later. Is it going to keep going up? Is it going to stay where it's at? It's going to retrace the old lows? We don't know. There's article after article that can say both things. I like this one. I've talked about it. This MarketWatch article, it made me laugh, but I think it really tells a story. It says, stock market looks like hapless Wile E. Coyote running off the edge of a cliff. And I've never seen a market so highly valued in the face of overwhelming uncertainty. Again, there's so many I don't knows out there that nobody can answer because we just don't know. We can't predict the future. And that's true always, okay? We never can predict the future, but when you're talking about major issues, major things out there that can create major differences in terms of your market, the money, your money, the markets, the economy, all those things, it's not often we have so many big things like this that we just have really a high level of uncertainty and I don't knows. So to keep staying the course, in my opinion, is kind of like I said earlier, it's like being on the Titanic rearranging the deck chairs. Now, I'm not saying the Titanic's going to hit an iceberg. I don't know if it is or not. Again, nobody knows. If it does, we know the results. If it doesn't, great. We're going to keep going and everything will be awesome. But to not admit or acknowledge or prepare, I think is foolish in terms of preparing for contingencies. So again, I find in most cases, when I'm talking to somebody, and particularly, I'm not picking on anybody, but Money Radio listeners are guilty as this as everybody else. I find a lot of overexposure to risk, to market risk in particular, and also a lot of overexposure to tax risk, future tax risk, when it comes to IRAs and 401ks, retirement accounts. I was talking to a gentleman just recently, his new client, where we spoke originally. I talked about this previously, but he was nearing retirement, successful executive, had taken a hit in the markets in March, liked the idea of a diversification, like I'm talking about, in a non-correlated asset, put it somewhere else so it's not a portion, a bucket of the money, somewhere else so it's not at risk to everything else. And he liked the idea of eliminating some tax risk. Because here's the thing, folks. If you have monies that's taxable in the future, can you tell me what the future tax rate's going to be when you take it out? Let's take an IRA or 401k type of account. And the answer is no. You don't. Again, that's another I don't know. Well, if you have a bucket of money that is tax-free and the tax rate's double in the future, well, 2 times 0 is still 0. Okay? So that takes that off the table. It's one of those risks you take off the table. And just because you're taking risks off the table doesn't mean you need to lower returns, by the way. We have options that can create some tremendous returns. I've stated 6% steady, consistent over and over again. 25-year history of that. I'll show you that. Many companies. And we have index options that have averaged 8.5% over the last 25 years with no downside market risk. So in most cases, how is that taking away returns? And the answer is it's not. What we're taking away is risk. We're taking away market risk, and we're taking away future tax risk. Particularly, if, like I said, if it's a taxable type of account or an IRA 401k, for example. My point is this. By taking some of those things off the table, eliminating those risks, okay, we can ensure some more security, some more stability in the future. That's what true diversification does. Diversification in a non-correlated asset. Okay? That's what I'm talking about. And then, don't ever forget the aspect of the personal bank concept. Remember, we're combining a banking tool with an insurance tool. We're allowing us earn credit 6 and access at 3 to 4. That means you're picking up 2 to 3% positive arbitrage on dollars you spent. Remember, these are dollars you're going to spend anyway. Okay? You're paying them using to pay off debt or pay for expenses. Those dollars weren't going to earn anything anyway, are they? Because once you spend money, what's your return on that money? Nothing. Nada. Zero. It's gone. Right? I'm talking about picking up 2 or 3% interest on those dollars. Does that mean you'll have more money in your future? The answer is yes. Because if you weren't going to get any return on that money in the future anyway, and now you are getting something from it, that automatically means you're going to have more money, right? It means your money will last longer. It means you'll have more to spend. Isn't that what it's all about? Isn't the end game putting money away for the future, the point being to have more money to spend in the future? See, it's not just about rate of return and how much you get, although that's important, but there's more to it than that. It's rate of return. It's what's the tax consequence when you access the funds. It's can you earn interest on money you spend in the future or not. You got to put all those things together. And that'll determine ultimately how much you'll have to spend in retirement, for example, or for anything else for that matter. So my point is, instead of, like a lot of people I run into say, well, I don't know what else to do because I'm not aware of anything else, or that's what I've been told. I get a lot of that. Instead of riding the roller coaster, and again, I'm hoping it doesn't continue. I mean, my gosh, it's been quite the roller coaster this year. You know, there's been periods where people have had to white knuckle it. You know what I mean? Why not take some of those funds? Why not take some of that portfolio and lock it down, get a nice solid rate of return? Whether you like the steady Eddie 6% or you want to go with the index with no downside, that's fine. My point is, why not lock some of it in, knowing it's going to be there, knowing you're going to get a return, knowing you're going to eliminate the tax risk, knowing you're going to eliminate the market risk, and then, yes, on top of all of that, when you access the funds and actually spend them, you can earn some interest on it. So therefore, you'll have more money to spend than you would have if you didn't do that. That's what I'm talking about when I'm talking about the personal bank concept. And that's why you should contact us at yourpersonalbank.com. And stay tuned for the last segment because we're going to touch on a few more points on this to show you how you can enhance your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third, and we're going to wrap this up. Today, we've been talking a lot about uncertainty. We've been talking about 2020, what the type of year we've been having. I don't think many people are going to forget this year. I think we're going to remember it for, we're going to remember it for a lot of things. Probably COVID might dominate it, obviously, just like some of those other times in our lives that we've had where we had significant events. It's kind of like for me, for example, 9/11 is one of those. I think it is for a lot of people that remember that. 2020 has almost been like several 9/11s. We've had several different things that have happened this year that I think are tremendously unexpected. You know, for anything from you can't believe that there's empty shelves in the grocery store to where you can't find toilet paper to things like riots in the streets or businesses being shut down or having to wear a mask to go to certain places. I don't think any of those things were expected. Anything anybody would have expected. Markets, monies, we've seen them go. We've seen them been tremendous low unemployment, great economic situation to 30% crash in a month, 30 days, to tremendous recovery back again. Again, all of those things pretty much for most people very unexpected. And again, we still have a big election coming up. That this is one of the few times where the two sides are dramatically different. In again, I'm not saying what's right or wrong or which side you're on, but I think everyone would agree they have very different focus, a different direction they want to go with the country. I'll put it that way. And I think it's pretty obvious. And depending on if we have one party in charge or the other, or we have something split, that's going to affect our money. That's going to affect our economy. That's going to affect us in many ways. And like I said, in most cases, I don't feel that's the case. Which party is in charge? In most cases, minor changes here or there for the most part. There's some people out there that like to really get worked up in the political arena. I get that. And try to drum up excitement or support or whatever. But I think this is one of those years where it really is different. And it really will impact our money and like I said, our finances and all that. And like I said, this article I've mentioned previously in the show is the Market Watch article. We're going to post it on yourpersonalbank.com if you want to check it out or pass it on. It's stock market looks like a hapless Wile E. Coyote running off the edge of a cliff. And never before have I seen a market so highly valued in the face of overwhelming uncertainty. And that's the comment I'm trying to make here. And the point I'm trying to make is this feels like the Titanic and we're in the ocean and there's a bunch of icebergs. Now, I can't tell you, I don't know if we're going to hit any of those icebergs or not. We may just sail on through and we've gotten past the worst of it and things will be rosy and great from here on out. Gosh, I hope that's the case. Or we may just hit one of those icebergs and go down. I don't know. And it's going to affect our money accordingly. And like I said, a lot of people, I feel like when they're talking about, I'm going to readjust my sectors and things like that, that feels like rearranging deck chairs on the Titanic. It feels like that just doesn't, you really need to diversify in terms of non-correlated assets, in my opinion. In other words, if you have some assets that are subject to market risk, that's fine. Have other ones that are not. And I was starting to mention, I was talking about a gentleman I met with in March. After March, his portfolio had gotten pretty much hammered. He was nearing retirement. He was far more at risk than he really wanted to be and realized he was at, and he had taken a huge hit. And recognized that he liked the idea of diversifying into a non-correlated asset and a lot of things I was talking about. And he liked the idea of eliminating future tax risk. But basically, his portfolio had taken such a hit that, he just didn't feel like he could afford to make the change at that time, which I understood. And fortunately for his case, he reached out to me again recently and he said, look, things have come back. I said, you've been given a second chance. He goes, exactly. That's how I feel. I think a lot of people, this recovery in the markets, I think for most people has come back a lot faster than most expected. Again, the drop was a surprise. I think the recovery was also a surprise. Certainly the speed of it, speed of both directions were breathtaking. And some people have been as he put it, he was white-knuckling it. I've heard that term a lot. But managed to come back through on the other side. I think he's given a second chance. So what is he doing? He's reallocating a portion of the portfolio, and he's putting it in the personal bank to eliminate risk, or eliminate market risk. By the way, it'll also eliminate future tax risk on his monies because he's concerned about future taxes with the level of debt. Do you realize, and that was another article I was going to get to, and I just maybe I'll talk about this another time, but do you realize that this year that our government, our Federal Reserve, has printed more dollars this year than they have for the previous 200 years? I want to put that in perspective for a minute. Our government has printed more dollars in 2020 than they did for the previous 200 years combined. I don't know. I'm not going to sit here and say I know what's going to happen, how that's going to impact our money. But that is a major, major change. And it's going to have, it just has to have impacts on the future of our money. And some of those things probably involve taxes. I mean, how is some of this money going to get paid back, right? You know, there's austerity measures. We saw those in Europe. You know, after 08, 09, we saw, you know, Greece and those places, Spain, places like that, go into extreme austerity measures to pay down their debt and resolve things, which would mean we would, you know, stop spending so much, our government. Do we go into some austerity situations like that? Do taxes get raised? Do we see a combination of both? Is inflation going to be, because there's other talk about raising inflation because future dollars are cheaper than borrowed dollars, you know, those types of things. Do we see a combination of all three? You know, the answer is, again, I don't know. And it's that uncertainty. And I don't think anybody knows. It's just not, I'm not saying I don't know. I don't think anyone really knows what's going to happen. Any or all of those things could affect our money dramatically. Again, by diversifying non-correlated assets, eliminating market risk on some of the monies, eliminating future tax risk on some of the dollars. By the way, if do you realize your personal bank's very interest rate sensitive? It's on a very low end. You know, paying 6%, the lowest interest rate environment in anyone who's listening to me in their entire lifetime. We haven't seen these kind of interest rate environments since the Great Depression. And the thing is, when interest rates are higher, if you go back in the late 90s, 2000, these personal banks were paying 7-8%. Okay? If you go back in the late 70s, you know, with a really high interest rate environment, we're looking at double digits. So my point is if inflation does come back, interest rates go higher, you're going to get credited more. I mean, that's just what's happened. It's interest rate sensitive, which is typically the opposite of a market-related asset. So again, in every respect, it's non-correlated. And that's really what you want. You want to diversify non-correlated. Put it way over here, and it's subject to a whole different set of factors than this other bucket of money. They're not correlated. They're not related in any way. And that's one of the things that your personal bank does, and one of the first things that many of the Money Radio listeners see and hear, and get them this, typically the first step, and when they start taking a look at this and saying, wait a minute, maybe I should consider this because I want to have some non-correlated assets. I like the idea of having some steady, consistent growth on my money. And hey, folks, let's be real. 6% tax-free today is not bad, okay? I like the idea of tax-free, reducing my income tax and reducing my future tax risk. That just makes sense. And the last part, positive arbitrage. You can earn interest on money you spend. So contact us on yourpersonalbank.com for more information. You'll get to talk to me. If you reach out to us, be happy to talk to you. And let's see how this can dramatically change the financial future for you, your business, and your family.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.